Let's bring in William Lee, joining me from the Milken Institute, the chief economist. Great timing to be here this afternoon, Bill. Great to catch up.
Hey, Oliver, thanks for having me.
So, how come the market seems to be having a little reaction to FOMC? I mean, we've been hearing Fed speak nonstop for like 10 days. Shouldn't we have already gotten the message?
You would think so, but the market's so obsessed with NVIDIA and AI, I think they forgot that there's a Federal Reserve out there. And I think that today is a reminder that these interest rates may not be going as far down and as fast as the market thinks. And Governor Waller's already told us that we're going to put off the rate increase until we're convinced inflation's going down. And as you said earlier, the last reading doesn't make a trend. One blip down doesn't convince the FOMC that they're ready to cut.
So where has the narrative been most misplaced, Bill? Walk me through the way you're seeing it right now, because it seems like we celebrate the thing that I see that I would offer to start is we're celebrating lower levels of inflation, basically, that are still above the Fed's target. So let's start there.
A premature celebration. The Fed has repeatedly told us they want 2% and they're going to get 2%. Now, the question is, how long will it take to get there? And the markets are always underestimating the amount of time it takes for the interest rates to really cut inflation down. By the way, a lot of the inflation numbers are driven by service sector inflation, which is running around 4% right now. And most of that is driven by housing, which we all know about, but also insurance costs and car repair costs and medical costs. These are shortages in skilled labor that the Fed can't really do much about. So the only thing the Fed can do is squeeze down on the other parts of demand to bring overall inflation down. And that's taking its time.
How much do you think they have effectively pressured the economy? We've seen some weakening, right? We've got unemployment rising, but still below 4%. It's like this game of rate of change versus nominal, where nothing nominal looks alarming, but the rates of change, Bill?
Absolutely. In fact, that's exactly where I wanted to go. A lot of people have been taken in by the readings in the labor market, 200,000 and so on payrolls. They forgot there's another survey. It's called the household survey, and that's shown on average about 94,000 new employees out there. And so what's the difference? Well, a lot of people are struggling because a lot of the jobs that are being created right now are low-wage jobs in the hospitality and leisure sector. And so people are having to get 2 or 3 jobs to make ends meet. And that's where the weakness in the economy really is. So as much as inflation is still robust and the Fed is going to be squeezing, they're keeping an eye on how weak the labor market really is. And they're paying a lot of attention to that labor market survey that says we don't have as much spending potential being built up in the labor market as we have in the past because the quality of the jobs is going down.
All right. So when they say that it is a tight policy, when they use that definition, like this morning, I had a guest arguing that Fed funds relative to GDP is still in a historically loose position, but it's not the only way to measure it. It sounds like we should describe it as tight.
The way that Governor Waller and all the members of the FOMC look at it is the way we at the staff always looked at it, which is real interest rates. Where's the inflation-adjusted 10-year rate? Where's the inflation-adjusted short-term rate? And those are hitting the 2% level. And historically, the normal level for real interest rates is somewhere around 0.75% to 1%. So we are tight. There's no question we're tight. But how long is that tightness required to get that inflation down? And that's the unknown right now. And that's where the Fed is playing a game of chicken with the markets and saying we're holding tight until we see inflation go down convincingly. And by the way, as you remember from statistics, it takes 3 to 5 data points to develop a trend and a convincing trend. And that's what you're going to have to look for, which means we're not going to see a rate cut until somewhere around November, December.
Because of that 3 to 5 data points for a trend, the last 3 inflation prints, which have been fairly warm, the last one still had month over month positive, but because it was slightly less than the previous, that was the market's kind of premature celebration, as you described it. But the trend then could potentially be going the wrong way, arguably.
Absolutely. In fact, it could well be that the last data point was an outlier, and we're in fact going the other way because the service sector inflation still hangs at 4%. And as long as service sector inflation, which is, by the way, 60-70% of spending, that's not going to let the Fed be convinced that we are going back down to 2% anytime soon.
There is a lot of talk about how housing and rents in particular are going to grind that inflation down. William, where do you fall on that?
We'll see when it happens. I mean, everyone says that the latest data show that, but the formulas that are used by the Fed and also by the BLS is showing that the PCE deflator and the CPI uh, overall service sector inflation is still high. And like I said, there are other elements to worry about, which are supply shortages in the car repairs and in healthcare services and so on. So there are places in services that really need to come down before the Fed is convinced that we're going to stay at 2%.
What are the odds in your mind that we would maybe have to raise rates between now and the end of the year? Is it the zero that many argue it is?
I'm closer to the zero camp than most because, again, the measure of tightness that we at the Fed have always used is the real rate of interest. And that real rate of interest right now is closer to 2% than 1%. And we need to get down to 2% for the new equilibrium rate.
Do you worry that the economy will buckle in a harder way, Bill, or should we be comfortable with kind of the way the rates have imposed pressure on the economy at the current kind of
Well,
rate of deterioration?
yeah, Oliver, I think right now at 2% real rates, the economy is starting to slow down. But because of the head of steam that it really has under it, it's unlikely we're going to get a severe drop of the sort that would bring us into a recession. The other hopeful part, which came out in the FOMC minutes, is they're also waiting for Nvidia. I mean, they're also waiting for the productivity gains that will come from the AI boost. And if that's the case, by the way, I think the market should be ready for a higher R star, a higher equilibrium rate of real interest. So instead of that 3/4 to 1% that I was talking about before, it may be closer to 1 or 2%. In which case, there's not a lot of easing that the Fed is going to be putting in place if, in fact, we get the productivity gains that AI promises.
And how visible do you think that outlook is? Bill, last thought, do we know really what impact just yet?
Way too soon to tell. It takes about 3 to 5 years before we can establish a trend for productivity.
Okay, great stuff. Thank you, William Lee. Great to catch up.
Thanks for having me.
Always like the macro discussion here, fresh off the FOMC minutes. William Lee, chief economist at the Milken Institute.